This isn't just a podcast, it's a movement. The Middle Ground Mike is fighting for truth and unity. Subscribe now, support us today. Links are in the notes. Stand with us. All right, everybody, welcome to the Middle Ground Mike. We got a great guest here today, Paul. For decades, Americans have really been kind of told that the economy's been doing great, just like we were talking before. But, it's not doing as great as people think when you kind of pull back a lot of the layers and the things that prop it up. And I think that's something that a lot of people don't realize. Paul's the author of a book called Capital Offense, Why Some Benefit at Your Expense. Paul, introduce yourself to everybody what you're about.
Yeah, well, thank you, Joe. Thanks for having me. It's great to be here.
You're welcome.
Yeah, so I was a professional investor for most of my career, managing up to $10 billion in assets I'm based just outside of Toronto, so for Canadian savers. And it was a great job. I loved it. But over the year, I became increasingly frustrated witnessing what policymakers were doing, all with good intentions. This is not a conspiracy theory. I think these are good people who had good intentions. But the issue is that, like many people, they take the shortcut, the easy path. Often the right thing to do is the difficult thing to do. And the difficult thing to do often will not get you reelected. And then it's very easy to have other people convince you that the easy thing is the right thing to do, which we can talk to about the specifics of that. And it was very predictable what was going to happen. And I've been warning my clients, which were financial advisors, for many, many years about the hazards of taking interest rates down to zero, of printing money to drive asset prices higher, that this would result in an economy that functions less optimally, that it would result in outlandish levels of government debt, that it would result in growing wealth disparity and higher inflation. And so that's where we are now. When I wrote my book, the whole idea behind it is to help democratize the understanding of how an economy really works, of how the monetary system really works. So the book is written in very easy to understand terms. You don't have to be in the finance industry. You don't have to be an economist to understand the message in this book. The goal is to empower people with truth and knowledge with respect to what's going on so that they can demand different decision-making from our policymakers. And once we demand that, they will do that because they're good people. They're not bad people, but for the last 30 years, they've been doing what we've been telling them to do, which is take on debt, spend more, because we've all been convinced that deficits don't matter. They do. They matter a lot. We're starting to pay or suffer the consequences of that, and it's only going to get worse unless we change things. So sorry, that's a little bit of a long-winded way of saying where I came from.
No, not at all. That really kind of goes, into your journey that we were talking about earlier. What I was saying earlier is, a lot of people think money is like neutral, but what they don't realize sometimes is policy, like in libertarianism, right? They always kind of talk about how government picks winners and losers. Well, that's what monetary policy does, even inadvertently, not even if it's not intentional.
Yeah.
It does that.
Yeah, no, exactly. And it really, part of the issue is most people don't understand the difference between money and capital. And that we can talk about how money is not neutral and the impact it's having. But maybe before that, I'll give an example about the difference between money and capital so your listeners will fully understand. So what makes the world go round is it's capital. It's the creation of capital. Money is super important, and we could not have a well-functioning economy without money, right? So it's very, very important. But capital is all the stuff that people produce, either a good or a service. Your podcast, you're creating capital, and your listeners are consuming your podcast, are consuming your capital. So the example I like to use is you make a bike and I make a suit. We've both created capital. So if we exchange them directly with each other, that's called direct exchange or barter. So now I've got your bike, you've got my suit, and importantly, we both created this capital and it didn't come at anybody else's expense. This is what capitalism, free market capitalism, is supposed to be. Whatever wealth you have, whatever capital you have, is supposed to be a result of capital that you created and then freely exchange with someone else for the capital that they created. Increasingly, people are now obtaining capital at the expense of somebody else rather than mutual benefit, which we can talk about. You make a suit, I make a bike, but we don't do direct exchange. We do indirect exchange through money. Money is called the medium of exchange. So you sell your bike that you created for $1,000. It's a nice bike. Use your $1,000 then to buy my suit. So now let's say you make 10 bikes, $1,000 each. So you sell them, you've got $10,000, you put that in your bank account. What that $10,000 effectively represents is the 10 bikes that you created. So you're temporarily storing those 10 bikes in the $10,000 of money. Your money is a vehicle storing the value of the 10 bikes that you produced. Now, you don't spend that $10,000 right away. You're saving it to go on a vacation at the end of the year. But before you get a chance to spend that $10,000, the central bank doubles the money supply. Now, when a central bank doubles the money supply, they don't create any capital to obtain that new money. They just create it out of thin air, push a few buttons. So it doesn't have any capital stored up in it. But it obtains capital as soon as it comes into circulation by taking capital from the rest of the money that's already in existence. So as soon as that new money comes into the economy, it takes 5 of the bikes from your $10,000 and puts it into the new money. So now your bank statement says you still have $10,000 in the bank, so you feel pretty good. But guess what? Your $10,000 now is only storing 5 bikes instead of 10. And so now your $10,000 will only buy half as much as it would have done before the central bank doubled the money supply. And that's why my book is called Capital Offense, because every time they increase the money supply, it's taking capital from your savings and giving it to somebody else. That's the difference.
That quantitative easing.
Exactly. And that's the difference between capital and money. So you can have an economy with capital and no money. It would be a small one. It'd be very, very small because you can't figure out what everything costs. Like how many kitchen chairs do I have to make to earn a flight to Florida or something like that? It just doesn't work. So you could have a small economy with capital and no money. But if you had money and no capital, there would be no economy at all. If you're on a desert island and one person's collecting coconuts and one's collecting water, others catching fish, and then you're exchanging those things, that would be all fine and dandy. But if someone came along and gave everybody $1 million each, that's not going to help the economy one iota. You'd much rather have a knife and a fishing net, stuff like that. So that's the difference between capital and money.
No, I mean, and that capital feeds into another part where we're going to talk, like housing, right? Like housing is broken a lot, like we were talking earlier, but a lot of it's essentially from investors, right? Big investors, corporate investors at that level, kind of siphoning it all up. Yeah. But where I think, from my perspective, obviously, and you can elaborate on it because you would know more, but just from a layman's perspective, it's not even necessarily to me that when I look at it, that it's being absorbed by investors, it's that there's not enough supply being built at a pace that matches everything else. And how capitalism is supposed to work, that, okay, yeah, you do have your institutional things, but also you're supposed to produce X amount to meet demand. Yeah. And there's so many restrictions in place on everything that stifles that ability, because you can do it responsibly. You can be capitalist responsibly and make as much money as you can dream of. Yeah. But it feels like it's, it kind of like piggyback on that a little bit, wrapped into it is, so like America's healthcare is not capitalistic. Like people think it is, but it's not. It's a very oligarch controlled, and they limit the players in the game, which drives prices up. Mm-hmm. So, and a lot of people don't always think about it like that, because they're like, all they see is big corporate America bad guys. What they don't realize is by limiting the players, you drive costs. Yeah. Same goes in housing. They limit the players. They put so many rules and regulations on every single little thing. Not that there doesn't need to be any, but they put so many on there that, let's say you and I are just an average guy, living in a small house. Well, you and I becoming a national player are so remote. Whereas 70 years ago, that was not the case.
Yeah. Yeah. And I talk about that specifically in my book. And, so there's 2 different parts here. So, I say, like, I'm a free market guy, but I don't agree with large corporations coming in and buying hundreds or thousands of homes, outbidding other people who are trying to buy them, because the corporations have much lower cost of funding. You can't compete with them. And so they buy all these homes that now you can't afford, and then they rent them back to you. I just think it's wrong. So you're absolutely right that, and with regulations and not in my backyard and all that kind of stuff, and that can drive home prices higher. But in my opinion, the real issue with housing, and it depends on the area, but generally, the real issue started back in 2001. And it came from what the central banks call a wealth effect. So you remember the dot-com boom and all the technology stocks were going through the roof back
Oh,
in the
yeah.
late 90s. Your company would go public and then call it .com. Basketcase.com, it didn't matter. It would go through the roof because it was .com. And there was a wealth effect from that. When people's stock portfolios were going up, they were feeling wealthier, and so they're going out and spending more money, and that was good for GDP, or gross domestic product. And then the whole thing crashed. Then there was a negative wealth effect from stocks going down, people spending less. So then there were these commentators, Paul Krugman and Paul McCulley from PIMCO, recommending that the Federal Reserve, the central bank of the United States, that they should create a new wealth effect through housing, because more people own housing. Those assets drive housing prices higher. And then as people's house, they see their house price go higher, they feel wealthier, they extract equity from their home, borrow on their home and spend it. That's good for GDP. And so that's exactly what they did. Alan Greenspan, who was the chair of the Fed at the time, he took interest rates down to 1%, despite the fact that the economy was not in a recession. This would have been considered emergency levels for interest rates, so low, like at war or whatever. No, the economy was still growing, and he kept it very low for a few years to drive housing prices higher. And that's exactly what happened. And every year, Alan Greenspan would talk about how much equity withdrawals were contributing to economic growth. And then the whole thing blew up. Now, and then they doubled and tripled down on it with QE, like you were saying, quantitative easing, printing trillions of dollars to buy assets to deliberately drive those prices higher. Now, a wealth effect that results from companies that are taking capital, let's say, and producing bikes or suits or whatever, and they're creating more capital. If companies are doing that, then that increased capital, increased profitability pushes share prices up and pushes stock markets higher. So if a stock market is going higher because the created capital is pushing those share prices higher, that's a really good and real and sustainable wealth effect. But if they're going higher because central banks are taking interest rates down to zero, all that's going higher is the price that you have to pay for that same amount of capital that's being produced. No more capital is being produced. You just have to pay more for it. That's not a real wealth effect. It's also not a real wealth effect when house prices are growing higher. So, and some of your listeners are not going to like this. And it's not their fault. Nobody's done anything wrong. I'm 63. My house, I'm in a suburb of Toronto, has gone up 4 times since we bought it in 2001. So my wife and I have done really well on our home, but we don't deserve it. Now, earlier I said, when you create capital, you create a bike and I create a suit, and then we fairly exchange it. It didn't come at anybody else's expense. But when my house goes up 4 times in value, what was the capital that I created? What was my contribution to society? It was zero. My house is not a productive asset. It's not producing 4 times what it did back in 2001. It hasn't expanded 4 times in size. It hasn't relocated to a glorious oceanfront view. No, it's the same economic good, the same size, in the same spot. The only reason I make 4 times on my home is because I benefited from deliberate policy to drive housing prices higher, and now a younger couple or a newcomer to our country has to pay 4 times what I paid for the same economic good. I mean, and it depends where you are in the States, but in many areas, you guys are facing a housing affordability crisis.
Oh, yeah, most of them.
In Canada, it's way worse. In Australia, it's way worse. So a whole generation of people, young people, are being priced out of the dream. They've played by all the rules. They've gone to school. They work hard. They're better educated than I was, yet they can't even dream of affording the same sort of lifestyle that I've been able to have and enjoy. And it's not their fault. And again, it's not like anyone at my generation broke any rules. No, we all got on a housing ladder. That's what you do, like we were talking before we started recording. And so, we didn't even realize that we were doing this, but this is the result. And unfortunately, there's only one fix, and that's for asset prices to come back down. And it's going to be very painful if that does happen. It's going to be very painful for a lot of my generation because they've been taught to rely on the increasing value of your home to help fund your retirement. And so what a lot of people in my generation did is exactly that. And they saved, or we saved, less than we would have done otherwise. I don't have to save money because I'm going to rely on my house. So within society, you actually had less savings and less investment than there otherwise would have been. So it contributed to declining productivity growth. And then for people my age who no longer have earnings power, it could be pretty tough if the value of their home went down significantly, which I totally understand. But in order to maintain high prices to fund your retirement, you have to price the next generation out of the housing market. So there's no easy way out. And it's not trying to blame people. My book is not a vindictive type story. It's just trying to explain what's happened, where we are, what needs to happen. How do we do it? How can we best do this with the least amount of harm for the most amount of people? And so I have my 10 steps at the end of the book, but it won't be easy. It
Not
won't
financially.
be easy. But again, it's not bad people, the politicians and central bankers who got us to this place. I believe that they actually thought that we would all be better off because of this, that, okay, we'll just drive asset prices higher and somehow that will drag the economy up with it. And then the benefits will all trickle down to everybody else. Well, they're not trickling down. They're not trickling down. And for so many people, never mind housing, it's just hard to get by. Prices keep going up. Your wages are not keeping track with inflation. Inflation is much higher than the government tells you that it is. And I talk about this in my book as well. One tool that they use or technique is something called hedonic adjustments. So if you buy a Ford F-150 and I don't know, 50,000, they're so expensive now, probably more, but 50,000 bucks, let's say. And then next year it goes up 10% in price to 55,000. The government will look at that new Ford and say, well, yeah, the price went up 10%, but Ford improved the quality of that car. You know, it's got better brakes, it's got better airbags, it's got better navigation, whatever. So they improved the quality of that car by 12%. So you're getting that much more truck for your money than you were last year. So yes, you're paying 10% more, but it's 12% better. So what they do is they reflect a price change of the F-150 of minus 2%. So they're telling you that the prices of trucks are going down, even though you can't afford one now because it just went up 10% in price. And so in my book, I have the example in 1996 to 2008, the average price of, I use like 5 cars as an average or as a sample set, went up something like, I don't know, 20, 25% over that 12-year period. But through hedonic adjustments, the actual CPI number for new cars in America actually fell from 96 to 2008. So the government's telling you that over 12 years, prices of new cars fell, despite the fact that they went up 25%. So that's why people don't believe what they're seeing from the government, because the government's telling them you're paying less, but you know that you're paying more. And you know that it's harder to get by, that you have less money at the end of the month to put away, that school's getting more expensive, healthcare is getting more expensive, you know? And yeah, so we're not on a good path and it's not sustainable and we need to change it.
Let's take a quick break.
The Middle Ground, Mike, isn't just another podcast. It's a movement for unity, for truth, for a future beyond the left and the right. But movements don't grow without people willing to stand up. Subscribe now on Buzzsprout. Fuel this mission directly on PayPal. Every subscription keeps the fire burning. The links are in the show notes. Be more than a listener. Be part of the Middle Ground. I mean, from your perspective, would paying down debt, the national debt, like per se, I know you're Canada, but the United States, would that really help maybe ease the bubble when it pops?
Well, it would help a lot if we didn't have the debt, of course, and paying down the debt would help a lot. But initially, it's called austerity. Well, actually, what a lot of economists and politicians call austerity today is just not living as much beyond your means as you were before. So if you've got a fiscal deficit of 6% and you go down to a fiscal deficit of 3%, they call that austerity. It's not. You're still living beyond your means. And it would. Now, some people will say that if you paid off all the debt, then that would get rid of all the assets that are U.S. treasuries. For instance, if you lend $10,000 to the government, so you're holding a T-bill, the government's got a $10,000 debt, but you've got a $10,000 asset because the government owes you money. But it's not an asset in society terms because the government doesn't take that $10,000 and invest it in some sort of productive capacity such that it can produce capital to pay you back your $10,000. The only way it can pay you back your $10,000 is by taxing somebody in the future $10,000 to give you that money. And so that's why people like Social Security, it's got this asset. So when people make their Social Security contributions and your company makes it for you, Social Security buys U.S. treasuries. And so everyone thinks that that's an asset. It's not. And by the way, Social Security is going to be insolvent by 2034.
Jesus.
Everyone thinks it's an asset, but no, it's not. Because when Social Security lends the money to the government use that for entitlement spending or defense spending or whatever, or interest on the debt now. So that money's gone. The only way that the government is going to make good on the money that is borrowed from Social Security is to tax people in the future.
Yeah, I mean, that makes sense. I mean, really.
Well, yeah, no, so paying down the debt would be very good, but we don't need to pay down the debt to make things significantly better. What we need to do is start running. I mean, it'd be very difficult to do. Even just having the debt grow slower than the economy, that would be a win. It would be much better if the debt grew slower than the economy, and then it would shrink as a percentage of GDP. But in order to get there, it would take tremendous change in attitude, because the government has convinced us all that we can have our cake and eat it too. We're all believing in this something for nothing myth that yes, we can take more out of the system than we put in, and it doesn't come at anybody else's expense. Yes, it does come at somebody else's expense. You just can't see who it is because the person who is suffering is 2 or 3 steps removed from you taking more out than you put in. So just being realistic about, and that's what my book is all about as well. It's not about condemning certain people for doing certain things. No, it's just trying to open people's eyes to how an economy really works and empower people with truth and knowledge and understanding and demand different decision making from our leaders. Said earlier, they will make those decisions if we demand it from them. It's also how you stay elected.
Yeah, we just don't give them a choice. That's what we have to do.
Yeah, no, exactly.
The big thing I noticed from like just in general is the big thing is just it's got to be clarity, right? Not just outrage. Like we need a clear picture to fix this.
No, exactly. I mean, people are very angry right now, right?
That's an understatement.
And the problems transcend politics. It's not about left versus right. It's how the system has been distorted with good intentions, but distorted with really bad consequences. And I believe that because people are suffering and they don't know why, you do get angry. Of course you do. And you look for someone to blame, naturally. But because you don't understand what's happening, it's very easy then for Republicans to blame Democrats and Democrats to blame Republicans. And then the anger just grows. And it's so sad. Like America is so divided. We have a place in Florida. My mom and our eldest daughter live down there. And so we go down there a lot, and we've got a lot of friends down there, Democrats and Republicans. And they're all beautiful people, all great people. And they agree on probably 95% of the issues, but they can't talk to each other anymore.
No,
they won't.
And it's very surprising, that we can't seem to, given the history of America, I mean, really North America, that we can't seem to get beyond this. I mean, partisan divides have always popped up in American history, but it just seems like we are really stuck. And Like, I think it would be very hard for somebody like a Ronald Reagan to really get going in this day and age to, become that because people will just be like, "You're wishy-washy."
Well, I watched your podcast the other day on JFK.
Yeah.
And, wouldn't that be nice if, the policies that were being put forward were, okay, my choice is a JFK or a Ronald Reagan,
Right.
and again, it's not the leaders today are bad or evil or anything like that. I don't believe that at all. I think this system is bringing out this behavior, and that this is what you need to succeed these days.
Yes.
And I'm not a political expert by any means, and I typically stay out of politics just because then people stop listening to you if they think you're left or you're right or whatever. And I try to stay focused on the money. But I think the divisiveness is a result largely of a broken financial economic system that is not doing its thing for enough people.
Oh, you're 1,000% right.
And I mentioned this in my book as well, that economics is a social science rather than a natural science like chemistry or physics. So it's a social science more like psychology, sociology. It's based on human actions, human decision making. And, they put some numbers to it. But I think one of the issues is a lot of economists, it's like hard science envy. They try to make economics more like a hard science like physics and use all these complicated formulas. And then they present them to politicians and say, look, here's the formula and here's why you should have deficit spending of 7% and run up the debt bill, and why we'll all sail off into nirvana because of these actions. But you look at those formulas, you can't make heads or tails of them. But it sounds good. And so as a politician, if somebody's giving you the easy way out and you think it's going to be good for everybody, then of course you're going to take that route. And it's called normative economics. So it's economic laws, not as they are, but economic laws as you would want them to be to enable you to make popular decisions. And then when you come along and you say, well, that's not actually correct. Here are the real economic laws, and here's why we shouldn't be spending more than we're earning, and blah, blah, blah. And then people get angry at you for pointing out the truth and for pointing out the fact that you can't have your cake and eat it too. That if you do, then it comes at somebody else's expense. You just can't see who that person is. And like we were talking about earlier, some economists liken it to getting angry at the law of gravity for plane crashes. Well, no, it doesn't make any sense. Or accusing gravity of unfairly targeting visible minorities. No, gravity doesn't do that. People do that.
Yes.
That's a human trait, right? So can we all agree what the economic laws are and then move forward with that understanding and that knowledge and that truth? But right now, we refuse to do it. And there's a lot of reputations tied up in all this as well, which makes it hard for people to shift off of stuff that they've been professing for many, many years. And I get it, but we're going to have to change, because if we don't, the system will change for us, because
Yeah,
the
no
system
doubt.
is not working for too many people. But the trouble is that they've misdiagnosed the patient. They've misdiagnosed what the issue is. It's not free market capitalism. We don't have that anymore. We do. So they've misdiagnosed the patient. And so they're going to throw out the free market baby with a crony capitalist bathwater, if you will. And, it really has resulted from, the way I term it is, over the last 25 years or so, central banks, they've sacrificed unwittingly, they have sacrificed the Main Street economy on the altar of higher asset prices, both stocks and houses, because they thought that would longer term be good for the economy. It's not. And so it's going to be tough to undo, but we can do it. I do believe that we can do it, but it's not going to
It's
be.
entirely possible. It's just not going to be, it's not an A to Z type of thing. It would be nice if it was like straight line.
Yeah, yeah, yeah.
You
No.
know, I mean, from your book, is there anything like in particular that you really like that really stands out that maybe like that one key thing that doesn't stand out to people that should?
Well, I think there's a lot in my book. And as I said earlier, I'll give you one thing, but it is sort of step by step. I use very easy to understand day-to-day language. I don't use financial jargon, and I don't, years ago when I was presenting to clients, my financial advisors, I decided to stop trying to impress people and instead trying to empower people with truth. So just keep it very simple. I use analogies and stories to help people understand. So if you read the book, you go chapter by chapter, you'll get it. You'll get it. And as well, because I think the average person is very smart, particularly when it comes to deciding what to do with their own hard-earned capital, with their own skin in the game. And that's one of the issues, in that politicians don't have their own skin in the game. All the skin that they have is yours. It's taxpayer dollars that they hand out. I say in the book that there should be no such thing as government subsidies, because it's not the government, it's coming from taxpayers. The government doesn't produce any capital of its own. All the capital it spends first obtains from the private sector. But anyway, so one thing, I think, there are a number of things, but I think that what I was talking about housing, it's a real big one, but that, we don't really deserve to be making money on our home. Back in the old days, the goal was to pay off your mortgage as quickly as you could, so you would pay less interest expense over the life of the mortgage. And then when you retired, your house was paid off, and that was your nest egg, and that would fund your retirement. So when you paid off your home, so if you made bikes for a living, and every time you sold a bike, you used that money to pay off some of your mortgage, essentially what you're doing is the wealth that your house represents is all the bikes that you've produced over the years that you used to pay off the mortgage. So you have your house is paid off. Your house is storing, I don't know, 25,000 bikes effectively. And then when you sell it, you're selling your bikes and you use that to fund your retirement, stuff like that. But if, like in my case, our house has gone up 4 times in value, so 25% of the value is a result of maybe the suits that I made, but then the other 75% is representative of is storing nursing services from someone else. It's a doctor services from someone else over here. It's a construction worker services over there. I was able to obtain all of that wealth and store it up in my home. It came from them. I know it's probably not resonating. I'm making it complicated.
No, I get the gist of it.
Yeah. So I get to store up other people's efforts in my home. And they only get access to that if they pay 4 times what I paid for the same economic good. And so I think with that, and I've been talking about this for many years, as you can imagine. As I said, I'm 63. And a lot of people my generation, when I tell them the story, at first they don't like it. And I did a podcast a couple of days ago, and, the guy read my book. He said, I love the book, but I got to be honest with you. Sometimes it was hard to read what you were saying because I didn't want to read it. I thought that he wasn't saying this, but we all like to think that if you make money on your home, you take credit for it. It's like I was a professional investor all my life. When my stocks went up, I thought I was a great investor. When they went down, it was a stupid market. So you like to think that you're good. You timed it well. You bought your house at the right time. Good for you, Musson. No. I just got lucky that we bought our home right when central banks started this fake wealth effect policy. But anyway, so a lot of people in my generation, they don't like it when I point this out. And I totally understand. And it's not long before they say, you know what? You're absolutely right. I don't deserve this. And so they would be willing to see their house price go down. It's not going to be much fun, but if our kids
make everybody panic.
Yeah, but if we want to see our kids and our friends' kids be able to live the same sort of lifestyle we had, then this needs to happen. But every now and then I do run into somebody who absolutely refuses to understand the situation. Not that they can't, they don't want to. And there's a saying by Upton Sinclair. He was a socialist politician figure back in the 1930s. And he said that if somebody's income depends on them not understanding something, then don't expect them to understand it. They don't want to. They want to continue living this mirage, if you will, and guilt-free. And again, people don't have to feel guilty about anything that they've done because we haven't done anything wrong. It's a bad system that we've been benefiting from inadvertently. And so I guess that's the one thing I think that affects most people directly.
Right.
Know what I mean?
No, and no, and that's important for people to know because sometimes people don't exactly put it to them in the way that maybe they should, so that they can understand it, and they may give them, like you say, not the jargon, right? So, like, they don't give them that answer that might go, okay, hey, A, B, C, D. They just kind of go with whatever, and then you have the result of where you're at, But Paul, I really appreciate you coming on today. This
Thank
is,
you.
I can tell you right now, people are going to like this.
Oh, yeah,
People
yeah,
people. I can guarantee you they are going to dig into this because this type of stuff is what people want to hear because to be fair, people just don't really trust a lot of the institutions out there telling them anything anymore because every time they do, they seem to get burned.
yeah.
I really appreciate you coming on the show. You guys need to, the link will be down in the description for Paul's book, Capital Offense, why some benefit at your expense. And sign up for Paul's blog. Paul, if you shoot me, I'll put it down in there too. The political economy. Who doesn't like stuff like that, But, everybody, thanks for tuning in. It's no left, no right forward. And I'll see you next time.
Thanks, Joe.